Bitcoin trades are at a deep discount after the recent halving. Don't believe me? Give me a few minutes and I'll prove it to you. And we are going to get right into it. But before we get started, if you appreciate this content, please do me a huge favor and help support the channel by smashing that like button. And if you're new here, you'll definitely want to subscribe so that you don't miss content just like this in the future. Now, to get back to the topic at hand, as I was saying, Bitcoin has a new countdown after the halving as the days of a sub $100,000 BTC price are numbered. Bitcoin begins the first week of its new halving epic in fighting form as bulls inch closer towards $70,000. This means that Bitcoin price action is potentially finding its feet again after a successful halving begins the latest chapter in Bitcoin's history. After a week of volatility and breakdowns to 6-week lows, Bitcoin has certainly tested traders' resolve, but has the market put the worst behind it? Historically, halvings tend to see Bitcoin price downside before a dramatic recovery, but this tends to play out over many months, not just days or weeks. This cycle, however, has been one of many firsts, notably a new all-time high for BTC USD before the halving event itself took place. With that said, anything could be possible in 2024 as miners adjust to the new reality and Bitcoin continues to navigate a fragile geopolitical and macroeconomic landscape. So let's take a closer look at the key issues for Bitcoin market participants going forward and go over the price triggers to look out for. We can say that liquidity is keeping the lid on Bitcoin's post-halving rebound. After an uneventful weekly close, BTC USD soon upped the stakes with a push beyond $66,000. That's its highest level since April 15th. Currently circling the $66,000 mark, the pair is a major focus for traders ahead of the week's first Wall Street Open. Last week was characterized by selling during United States trading hours. Analyzing the current order book setup, we see a large block of ask liquidity immediately above the spot price. Seems like this fat block of BTC ask liquidity may have been put in place to prevent a green W close. I'm speculating about the possibility that one of the BTC ETF institutions put that up to keep the price from running back to the $70,000 range before TradeFi markets open and they have a chance to buy a dip. This liquidity was not supplied while Wall Street was absent. In fact, it may be the reason they didn't dump it on the weekend. After all, there's no benefit for them if they can't buy. The latest order book data shows Bitcoin eating through some of this liquidity at the time of recording, with the majority stacked around $66,600. Take a look at this BTC liquidation heat map, which shows that despite running to weekly highs, BTC USD did not liquidate large numbers of short positions, totaling a mere $17 million over the past 24 hours. For months, analysis has flagged various BTC price phases common to Bitcoin's previous two halvings. Bitcoin has adhered to these this year, at least to an extent, while also setting new records, such as posting an all-time high before the halving, not after it. This means BTC USD is in a reaccumulation phase consisting of consolidation around the halving. While this would explain recent price resistance, the reaccumulation range could act as a perfect springboard for long-term gains. What if Bitcoin has already revealed the top and bottom of its post-halving reaccumulation range? Then the prices within this range would be the best we will be able to get before Bitcoin is finally ready for its post-halving parabolic upside. With the block subsidy halving now complete, market participants are considering how Bitcoin will react going forward and whether it will set a new paradigm compared with previous halvings. Bitcoin, having given investors a buy-the-dip opportunity last week, should repeat it while staying within the current range over the coming weeks. Adding to the volatility catalyst this week is a familiar face in the form of U.S. macroeconomic data prints. These are set to include first quarter gross domestic product, GDP, and jobless claims, all leading up to the March print of the Personal Consumption Expenditures, PCE, index on April 26th. The latter is known to be the Federal Reserve's preferred inflation measure and should thus be closely watched as economic policy hangs in the balance between hawkish and dovish. Risk assets continue to look for hints that interest rates will come down sooner rather than later, while recent language from Fed officials has favored a higher for longer approach. In an unusual development, central banks in Europe and the United Kingdom are poised to begin a rate cut cycle before the Fed. Will PCE inflation data show another increase in inflation? All eyes will be on PCE inflation data this week, the Fed's preferred inflation metric. It's no secret there's been a sharp decline in sentiment among U.S. equities. The classic yardstick for this, the Crypto Fear and Greed Index, has shifted from greed to extreme fear in a matter of days. Bitcoin's correlation to equities could thus return as a topic of conversation. Bitcoin's transaction fees have made the headlines for the wrong reasons since the halving, at one point passing a near-record $200. Thanks to the runes phenomenon, Bitcoin miners have seen bumper earnings despite the 50% reduction in block subsidy. All in all, this new halving epic represents a seismic shift for Bitcoin as a whole. Bitcoin electrical cost, which is the raw cost of electricity per mined block, is now higher than spot price at over $77,000. Bitcoin miner price hit $244,000 on Saturday. This is the block reward plus fees per Bitcoin mined. It boomed as transaction fees hit $230 plus. That's about 4 times the prior all-time high of $68 that was set in 2021. In other words, Bitcoin is trading at a deep discount. BTC USD trading beneath its electrical cost is extremely rare and never lasts long before redressing the balance. This comes from a combination of BTC price upside, unprofitable miners shutting down, and fees remaining higher than before. I'm expecting a bit of all three of these. Bitcoin's days under 100K are numbered. We can also see that crypto greed returns after the open interest wipeout. While stocks enter a period of cold feet, crypto sentiment has gone the opposite way. BlackRock Bitcoin ETF hit 69 days of inflows on 4/20 halving day. The Crypto Fear and Greed Index, which is the crypto counterpart of the stock sentiment gauge, currently sits just below the extreme greed zone at 73,100. Just days ago, on April 18th, the index measured 57,100, indicating greed had been practically flushed from the radar. This accompanied not only a BTC price retracement, but also a reset across exchanges in the form of steep declines in funding rates and open interest. The market has gifted us with a beautiful reset in trader positioning for Bitcoin. OI-weighted funding turned negative for the first time since October 2023. That was before Bitcoin ran from 27,000 to 46,000 without any meaningful dip. This OI funding weights chart shows just how much the landscape has changed since Bitcoin hit its latest all-time high of $73,800 in mid-March.